All right, guys, so let's get back. And again, you got it, for those who are here, a taste of a flash mob. You can Google it. Friends with benefits and flash mob scene. Let's pick up where we left off because I do think the more you do this stuff, the better off you are. All right, so question 2. Question. Jacqueline, you've got to say it really loud because I'm sure. Shannon, did you hear that? That'll work. Did I hear your shout voice, Jacqueline? Did I see? I don't even know. Renee, was that you? All right, Renee, can I hear your shout voice?
The 741 and the 751, shouldn't they always total the overall gain?
Yeah, I mean, that's what's going to gain or loss, right? Has to come out, right? It's got to be that equation, yes.
I'm going to email you a question about how much.
All right, you send me an email. All right. Question 2, ABC cash by the general partnership says made a 754 election. 754 election. During exam, pull out that red pen, special rules are going to apply, right? As the following balance sheet at the time, D purchased C's interest for $60,000. None of the partnership's assets were contributed by a partner, so 704C does not apply. What is D's personal inside basis in each of the assets? In each of the assets. So we have to come up with a 743B adjustment. Agreed? Everyone on that page? Then we're going to have to do a 755 allocation. So everyone come up with a 743B adjustment. Got a number, and then the 755. What's his outside basis here, guys?
60.
70.
Oh, liabilities.
Oh,
Yeah.
Don't want to start off on that wrong foot. Outside basis is 70, right, guys? Now, to figure out the 743 B adjustment is subtract out previously taxed capital, right? Now, I'm going to tell you, you can eyeball this and come up with the right number, but this is not going to always work. I can look at this and say, you know what? What's the previously taxed, his proportion of the previously taxed capital? How much? No, it's 30. It's 1/3 of 90 plus the liabilities. His previously taxed capital, guys, is gonna be 40. It's, right? Look at the inside basis, it's 30, those are monies that have already been, right? After-tax money, plus liabilities. So it's 40, but how do we get there, okay? It's one thing to eyeball it, right? But it's another thing to actually come up with a number.
What did you eyeball?
Then, let me, in other words, I eyeballed the adjusted basis, which is 90, right?
Okay.
And 1/3 of that is 30,
Oh, okay.
and then we include the liabilities.
Okay.
So previously taxed capital, what would he get on liquidation of the assets, guys? How much would he get on liquidation of these assets? If all the assets were liquidated and the liabilities were paid off, how much cash would be left in the bank account? Wouldn't it be 180?
Yeah.
210 less than 30 of liabilities, right? So there'd be 180. How much would he get? We get 60. Everyone agree? And how much losses are there? On the land, there's a total of 15 divided by 3. So we get 5. So you would add 5 and minus the gain. No, the gain here is the accounts receivable of 10, right? The inventory of 10 more. And on the building is how much?
25.
Isn't it, what is it, guys? 25, right? Isn't the total there 75? So his 1/3 would be 75? So isn't the total gain 45? Everyone got that? Plus the liabilities, okay? Previously taxed capital will include plus 10 of the liabilities. So the 743B adjustment is 40,000. Again, this is cash, losses, gains, liabilities. Okay? That's where we came up with this number. So this is the 743B adjustment. Now we have to take that 40,000, we have to allocate it, right? In accordance with 755. Okay? How much gain is in the inventory? There's 20 of 751 gain, right? Receivables and inventory, there's 20 of potential gain. And how much with the land and building? There's a $5,000 loss and 25 gain, 20, right? So there's 20 and 20, right? So how are we gonna split the 40,000? 20-20, right? 50-50. So what we're gonna do here is take the accounts receivable, inventory, land, building, the inside basis, plus or minus the adjustment, will equal the basis. And this is spelled out, guys, in regulation 755-1B3, 3 little i's. I'll repeat. 755-1B3, 3 little i's. What's our starting point? 0, 10, 10, 10, right? That's what it starts off at. What's our adjustment? Well, the accounts receivable and inventory get allocated 20, but they both appreciated by the same amount. So we're gonna allocate 10 to 10. The land went down -5, and the building went up by 25. Sorry, you're right, I apologize, absolutely. Get to invoke the after 8 o'clock. All right, better have another sip of the cold brew. Boy, that's good stuff. All right. Everyone got that? And that makes sense, right? It's as if he bought each of these assets individually. Question B. What is D's personal inside basis if he had paid 70 rather than 60 for C's interest? So, what's going on here? Now what we have going on here is goodwill, right? That's why this person, he is paying an extra $10,000, right? So we have to add goodwill. And what do we have to do here in terms of his outside basis now is 80, right? And what's the previously taxed capital? How much cash would he have received if everything were liquidated, guys?
60.
Let me. When did he receive 70,000 in cash? Right? The losses would be the same. And now, when do we subtract? Isn't there another $10 worth of gain here? So we minus 55, right? So this is equal plus 10 in liabilities. And this equals how much? Doesn't it equal 30? So the adjustment here is 50, right? So the goodwill has 0 basis, but now, just like we did before, we're going to disproportionately allocate now of that 50, 3/5 of the $50 gain is allocable to the capital assets, including goodwill. 3/5 and 2/5 or 20,000 is allocated to accounts receivable and inventory. And not surprisingly, this would be 10. So that's the answer to B. Questions, issues, concerns? I'm sorry? It's 50. Well, I mean, the previously taxed capital ends up being 30, with the adjustment being 50. Question C. Same as A, except that D buys C's interest 60,000, except that C contributed the accounts receivable to the partnership at a time when its fair market value of the receivables was 30, and their basis was 0. Alright, now, C is contributing these assets and D is buying into it. Now, come up with what the 743B adjustment should be. And you better not try to eyeball it, else you're going to get into trouble.
Professor,
Yes.
I might have missed something, but the 743B adjustment, I guess, in the.
Just say it loudly, Sandra, because I can barely hear you.
For the 743B adjustment, you got 50 for the second problem.
Yeah, in this problem, it's 50,000.
Okay, and then you're taking that adjustment and breaking it out. How much are
Between
you getting?
the accounts receivable and inventory, which have appreciated by 20,000, and the three other capital assets, land, building, and goodwill, and the building is probably a 1231 asset, but be that as it may, has appreciated by 30,000. So I'm allocating 2/5 to the 751 assets and 3/5 to the capital and 1231 assets, right? Right? When you look at the appreciation in each, the relative appreciation in each. Now, in the problem C, come up with the previously taxed capital. Now, question C. What's A's, I should say, what is the partner's outside basis? 70, right? Everyone agree? He buys it and buys it for 60, but his outside basis, because the liability is 70, right? Now, what is the previously taxed capital? What's our starting point? How much cash would he receive on a hypothetical sale, guys? By 70. What did he again receive? 60? 60. Everyone agree? So let's go through this. 60. The loss on the land plus 5. Everyone agree? Minus the gain. Now, how much gain? And here things get sticky. Because there's a 704C gain, right? When D buys C's interest, right? Isn't C, under code section 704C, supposed to be tagged with the $30,000 gain on the receivables, everyone? Everyone agree? C is supposed to be tagged with that 30,000. Agreed? C is the one who caused the problems here. C should be tagged. If D buys C's interest, guess who's going to be tagged with that? D. So he's going to be tagged with the $30,000 gain, the $10,000 gain on the inventory, and the $25,000 gain on the building. So when you do the arithmetic, it's 65. I'll repeat. You got the 704C gain of 30, plus the 10 gain of inventory, plus the 25 in the building. The total equals 65. So the previously taxed capital is 0, and then you have the liability of 10. So what ends up happening here, you can subtract out, like we did before, what we did, depending on how you want to look at this, plus 10. So this ends up being 60 is the adjustment. Because you subtract out previously taxed capital plus the liability. So it becomes 60. And therefore, what would end up happening here, the adjustment would be 30, right? I mean, because there's no goodwill in this problem, so I would have to, let's put after the 755 allocation, we're going to allocate the 60. We'll just see if I can write it right here. So the accounts receivable, the inventory, the land, the building. The adjustments would be on the receivables 30, the inventory 10, just like what we had before. The land, we would subtract 5, and the building 25. If I do my arithmetic right, it should be 60. Total adjustments. So this is the 755 adjustments.
Building should be
25. These are just the adjustments. That's this column. I'm just giving you the adjustments. In this problem, obviously, there's no goodwill. All right, why do the authors have problem 2C here? Because when you're computing previously taxed capital, you got to be aware of code section 704C. And this is an illustration of how 704C can come to haunt you because the buying taxpayer can be saddled with a larger potential gain, and as a result, it's going to cause a larger adjustment. Let's do another problem, 3. The DEF cash method general partnership, which is nominated a 754 election, phew, right? Has a general balance sheet, following balance sheet at the time G purchased D's interest for $50,000, right? Which makes sense economically. A lot of the assets have declined in value, so it's not looking good for this partnership. D contributed the inventory to the partnership when its inventory value was $15,000, right? So its inventory value, he bought it for 30, okay? He bought it for 30, contributed when it was worth 15. It's gone down another 5,000, right? Everyone see that? He bought it for 30, contributed when it was worth 15. It's now declined another 5,000. Will the basis of the partnership assets be adjusted under 743 as a result of D sale to G? I just want to. Is there any adjustment, guys? The answer here, just to take a quick glance, and Anna, I should ask you this question because you said sometimes they're forced. Would they be forced here? Look at code section 743D. 743D says sometimes you're forced to have a basis reduction if the adjusted basis in the partnership property exceeds fair market value by more than 250,000. Everyone see that? Is that the case here, guys? The answer is no. Everyone see that? There's a potential loss here of 200,000, not 250, right, Anna? So the mandatory built-in reduction. Remember, 754 can go both ways, right, everyone? 754 is not only a one-way winner takes all. G urge the partnership to make a 754 election? The answer is no. G's a happy camper. G's the beneficiary of the higher tax basis, right? Because as a result, can result in potentially less gains, right? Or more depreciation deductions. So G would not want. Question B, assuming no adjustments are made to the basis of the partnership assets, what will be the result to G if the partnership sells the inventory for $10,000? And what are the results if the partnership sells the land for $90,000? Okay, so what's results, guys? Let's take the inventory first. Now, if you couldn't tell, guys, the author's point in problem 3B is to illustrate who brought the majority of that loss to the table on the inventory, guys. Who brought that? D, right? Is D in the picture anymore? Can that loss be allocated to other partners? The answer is no. Just for your notes, you'll look at this in the morning. Code section 704C1C. I'll repeat. Code section 704C1C. C1C. Got that, Kevin?
C1C.
C1C. All right? That loss is going to be disallowed. Poof, disappears. So how much loss is there really to the partnership? Because that $15,000 loss that D brought to the table disappears. But the loss in the hands of the partnership was how much? $5,000, right? So they can get, with the loss that was in the hands of the partnership, $1,666 apiece, right? I'll repeat. The $15,000 loss that D brought to the table cannot be shared. But the remaining $5,000 can be shared between and among the other partners. Or, if you do the arithmetic, what's 5,000 divided by 3? $1,667. Now the sale of the land. How much loss would the partnership recognize? 180, right? And how is that going to be allocated? Well, that's not a pre-contribution loss, right? That's not something that was contributed. So that would be divided between the partners or among the partners, $60,000 apiece. Everybody have that? Right, so the authors are just trying to illustrate vis-a-vis that problem. Pre-contribution losses which can disappear versus losses the partnership experience that purchasing partners can fall into. So let's just review before we move on. Keep in mind that this chapter, guys, is not a long chapter, okay? And the general rules are not that challenging. It's the exception. So in chapter 9, just back to page 303, consequences to the selling partner. And this, again, guys, at the risk of repetition, is encapsulated in one page. One page. You do your own one page, whatever you want, but it's one page. The first half of the chapter comes down to our dance moves, right? Step 1, step 2, step 3. That's all you need to know. Not surprisingly, a partnership, now someone may say, going back to chapter 1, okay, see, this makes corporations more attractive because when you sell corporate interests, you get capital gains, and here it's telling you you get capital gains and potentially ordinary income. But if you recall the example with Julia, no one, unless you're really gonna, be as dumb as the sheetrock, is just gonna say to Julia, oh, you're the corporation that owns that $1 million building and has a $100,000 basis, no one's gonna pay Julia $1 million for her shares, right? Unless they have very, very bad tax counsel, right? So, yes, it's true with a partnership interest, you don't command all capital gains typically, but it all comes out in the wash. Now, the second part of the chapter, so the first part, everyone can handle that 3-step dance move, right? The second part of the chapter deals with what are the effects to the buyer. And the effects to the buyer, guys, generally are not complicated. In fact, 90% of the time, it's simple. They buy the interest, that becomes their outside basis. There's no effect on the inside basis. Done. But you got to be aware and ask your client, do you want me to negotiate a 754 election on your behalf? And what are the consequences? Normally, again, if you're talking to a client in just plain language, you say to them, you'll get a basis equal to fair market value, inside basis. And that can prove good because it may reduce your subsequent gains, increase your subsequent losses, give you added depreciation deductions, but there is a downside that may happen as well, which we're going to explore. But in a nutshell, that's it. Everyone's got the general rules of this entire chapter, can be articulated that way. So, recommendation, this weekend, practice, and sales pitch again. 2 out of the 3 lectures on Saturday night will be on partnership. And if I don't blow it in my pronunciation, it's a way to celebrate, did I say this right? Diwali?
Diwali.
Diwali. I gotta get the V right. Diwali. All right, so it's the night before Diwali, and we can all celebrate as a team. All right. Can't think of a better way to celebrate both tax and Diwali. What a night. All right, chapter 10. You guys ready? And chapter 10, guys, you're going to see, and I implore you, you see on the next page of my proposed outline, there are a lot of intricate rules, okay? You have to be in a position with operating distributions to identify how these rules apply, okay? But, so it's detailed oriented. Notice, when it deals with both this chapter and the last chapter, very mechanical. There's not much case law in this. Why? The controversies come down to, did you apply the law correctly or incorrectly? If you applied it incorrectly, you got a malpractice suit. If you applied it correctly, you get a nice fee. Okay? It's not going to end up being a tax court because You either got it right or wrong, and the facts are going to be indisputable. All right. So, guys, in your ever-growing repertoire of code sections, we're going to add a few more. Why not? Let's go to code section 731. And just toy around with some things here. We have 731, 732, and 733. 3 different code sections. All under subpart B of subchapter K. In other words, if you look right above code section 731, it's entitled, what? Distributions by a partnership. Distributions by a partnership. And generally, gains shall not be recognized to the partnership, or to the partner, I should say. This is under 731A, unless they get essentially cash in excess of their tax basis, right? Not surprisingly. And losses generally are not recognized, except that upon a distribution and liquidation, only upon liquidation can there be a potential, can the partner generally potentially command a loss, where the only property being distributed is essentially money and receivables and inventory, okay? So if there's a limited amount, kind of property being distributed, it can result in a tax loss. Okay? Generally, the partnership itself, 731B, recognizes no gain or loss. Partners can recognize gains or losses. The partnership will not. Distinct contrast with corporations. Marketable securities, I'm going to get this down to one sentence. 731C. Marketable securities, guess what? Are treated as a cash equivalent. Not surprising, right? Are marketable securities generally the equivalent of cash? But in this context, definitely considered the equivalent of cash. Now, there's a lot going on in 731C, but for our purposes, I just said what you need to know. Marketable securities treated as cash. Code section 732. You want to have some fun tonight? This is not to be done on a single espresso or double espresso. Triple espresso is what's required, bare minimum. Triple. Because 732 supplies what is your tax basis? What is your tax basis in the distributed property? Now, on one hand, if you want to just be a simpleton, but it's not going to work all the time, so be careful. Your tax basis in the property will be equal to the whatever the partnership's basis is in the asset, okay? It's not a bad starting point, okay? Let me repeat that. When a partnership makes a distribution of partnership property, it has an inside basis, right? The partnership inside basis of the asset it holds. In general, that will be the partner's basis in the asset, right? Does that make sense? Sure. And this should remind you sort of like the world of gifts, right? It's like a carryover basis concept, right? And it preserves the gain or loss. Agreed? And that's the whole idea of partnerships, right? It's sort of treated in many instances as a nothing entity. You put it in, and the partnership gets your basis, right? We've been there and seen that in the 721 transaction. And then when the property comes out, makes sense. You would have the same basis as the partnership. That's the general concept, but life is not that simple, right? And what we see in Code Section 732, and I tried to outline for you, that the code makes its business to try to give the basis, because life is not that simple, where there could be multiple pieces of property coming out of the partnership. In other words, we make a distribution to EK, and she gets both inventory and a capital asset. And the partner's outside basis isn't sufficient is less than the total of the inside basis of the property being distributed. Well, where does that basis get allocated? And the code has definitive rules. This is not, well, scratch your chin, I'll allocate some there and I'll allocate some there, and hey, as long as I come up with a total that equals my outside basis, all's hunky-dory. That's not how the rules work. If you read the rules under 732, and I don't want to go word for word by my outline, but if you look, let's start with the operating distributions on my outline. If some of you have it on your computers, some of you may have printed it up, some of you haven't seen it even yet, but it just talks in general terms about the general rules. Then it talks about the special rule for distributed property. Okay. Now, I just will point out, and then we'll talk about the rules itself. 733, not surprisingly, code section 733 says that your outside basis is reduced by whatever the distribution of the inside basis is, right? Let's repeat that. That your outside basis is going to be reduced by the cash you receive, that's a no-brainer, plus the adjusted basis of the assets being distributed to you, right? So that's your outside basis, but code section 732 answers a different question, right? You have a lot of basis going on here. And what I mean by that is 732, once again, focus you on what is the basis of the partnership property you, the partner, or your client is receiving. Code section 733 says what's your outside basis once the dust has settled. Everyone understand the distinction between the two? 732, the property you physically receive. 733, your piece of paper, your partnership interest. What is your basis in that piece of paper? Your membership interest, your partnership interest, once these property distributions have been made. All right. And like I said, this is intricate stuff. I'm sorry, I'm repeating myself, but if you don't follow the steps that I've tried to outline, you will not get the correct answer, okay? And be forewarned, it's very easy to create multiple choice questions, right? Saying, okay, what is the basis in the distributed property, right? In the tractor, in the inventory, well, the accounts receivable. So you can anticipate, and I'm saying this not only because it will be on the exam, but when you have clients who come in, and I'm going to say 70–80% of your client, for your closely held business, they're going to be operating partnerships, and they're going to be making distributions of property, and they're going to harbor expectations you can tell them what their basis and their assets will be. So you got to know this stuff, guys. And yes, you got to know the general, but you do have to know the specifics. All right, so the author is beginning on page 341, I should say. Talk about distributions of cash, and talk about general non-recognition rules. They move on from cash on page 341 to 342 to distributions of property. Okay, and that's when life gets interesting, and they try. I'll leave it up to you. They try to spell out in their own verbiage on page 343 how code section 342 operates. They try to point that out. You got to go through that yourself. I just point out, once in a while, this does not come up too often, on page 344, there's an elective code section, 732D, that allows a distributed partner, the distribution is made within 2 years. I have the 2 years circled in red, and you can treat that distributed property as if there were a 754 election in effect. right? This is done at the individual partner level. Individual partner level, you can make a 732D election. There's a fairly lengthy discussion beginning on page 345 about distributions of marketable securities. For my purposes, like I said, they're going to be treated as cash, okay? That's largely what, you're not going to get anything more complicated than that. I will point out to you that the only way they're not treated as cash, some of you or your clients may have investment clubs where the only thing the partnership holds is marketable securities. And Congress doesn't want to force people who join investment clubs to force them to recognize gains or losses. So only if it's in the context of an investment club are marketable securities not treated as cash. So I just want you to know that. This is spelled out on page 346. That it does point out that that's a specialized exception. There are two revenue rulings, neither of which are hard to follow. Is that on page 347, talking about revenue ruling 94-4. And this revenue ruling, the takeaway of this revenue ruling is that, as you know, a reduction of liabilities is treated as what? As a cash distribution, right? Reduction of liabilities is treated as a cash distribution. And rather than force a partner necessarily to have, and if they have a small outside basis that could give rise to a gain. So this revenue ruling says that could be treated as an advance or a draw. In other words, sometimes partnerships before year's end give money to partners before they essentially what's called as a draw. They're essentially lending the money to the partner until they can figure out actually what the partner is going to receive. If that's the case, don't treat this as a distribution. Treat it as a loan. A loan is not a distribution, right? There's an obligation to repay. And if it's treated as a temporary draw or loan, what will end up happening is maybe towards the end of the year, the outside basis will increase. Why? Because the partnership proves profitable. So often is the case that this revenue ruling and other features say don't treat that de facto distribution as if it's a real distribution. Treat it as if it's a loan, because this way it will not trigger gain prematurely. Dee, you had a question?
How long can this draw?
Until the end of the year.
Okay.
Until the end of the partnership year.
Even if it's taken in December and it's a calendar year?
What is taken in December?
I mean, even if the draw is taken.
If it's calendar year, you're good to go until December 31st. Hopefully the partnership will prove profitable and therefore it will not result in a gain.
Otherwise it counts as a distribution?
And it will count. Got to be careful. Revenue ruling 79-205. You might, now what I've done here in my margins, guys, the only way you can figure these things out, again, is to be a proactive reader. And I try to subscribe by my own philosophy, and in the margins, I write down what is the adjusted basis of each property 1, property 2, what liabilities it's subject to, A and B's initial tax basis. Again, not pretty. I don't claim to be pretty, but I claim to be an active reader. By being an active reader, if you read this, it's really not a challenging revenue ruling. What is the takeaway of this revenue ruling? The takeaway of this revenue ruling is that liabilities can be netted. In other words, sometimes when multiple properties are being distributed, that a partner will absorb some liabilities, okay? Will absorb, which will be considered like they're making a capital contribution, and they will shed liabilities, which are treated as a distribution. And this revenue ruling said, when you have multiple properties being distributed, don't just look at what they're shedding initially, look at what also they're absorbing, and then net the two, right? You had to read it for yourself. I'll leave it at that. It is truly not very hard to read as long as you write it out. That's what I will say to you. My goal line is just to do at least one problem on page 351, because if I do one problem, I think it will make it easier. I'd like to think that you can have an easier time handling the rest of this chapter, all right? Maybe it's foolish on my part, but that's at least my goal line. So let's just do one problem, and then we'll call it a night, okay? Let's look at problem 1 on page 351, because by doing that one problem, again, I could be mistaken, but I do think that I will put you in a better position to persevere. On July 1st, ABC Partnership, calendar year partnership, distributes to each of its equal partners $10,000 cash and land with a value of $10,000, basis of $5,000. A, B, and C have outside basis of 20, 10, 5. So, just so you know, again, proactively, what I've done in my margins, I put down cash, 10,000, and they're going to distribute land. And A, B, and C. Okay, so they're going to make distributions and discuss the tax consequences of the distribution to A, B, and C. Each of them will own his partnership interest for several years. So everyone understand A, B, and C have 3 different outside bases, right? And if you don't mind me saying, this is a great exam question, okay? Because everyone in this room should handle this, okay? If you can't handle this, you must. I mean, you don't have to do anything. It's not my nature. But you should reach out to me, because you will see something, I promise you again, because I want you to do well. You will see something like this, so make sure you know this, okay? This is just pro forma. You got to know this, okay? And it's going to ask you, what is A's basis in the property it's receiving? What is B's basis in the property it's receiving? And C's basis, and your outside basis. So under 731, let's go through 731. Any gain or loss when A receives this property? No gain, no loss, right? What is A's? A started off with a $20,000 basis, right? What is A's basis going to be when the dust settles? What is A's basis? What code section? 733. A's basis when the dust, after these distributions are made? Give me a number, Simi. Simi, you got a number. Okay? And kid? Why 0? What's its starting point? Say again? 20. What's the basis in the property he's receiving? I'm sorry? It's getting cash of how much? That's going to reduce his basis from 20 minus 10. But he's also receiving what? Land with a basis of what? 5. So his basis goes to 5,000, right? 20 minus 10 minus 5. So his basis becomes equal to 5. Everyone got that? Nathan, you got that? I got that, I couldn't hear.
I did.
Okay. Everyone got that. $5,000, right? Now, we have a final question. Cash, we don't care about the basis. What's his basis in the land? 5. Give me 5. 5. What's your authority? What code section, guys? DK, you don't look happy. You're thinking, but you don't look happy while you're thinking. You should have a smile on when you're thinking. Alan, what code section? What code section? 732. 732. I already wrote it because Ramon's saying, yeah.
Which is why we thought it was a trick question.
No, it wasn't. I know. What color is George Washington's white horse? Come on, I know. All right, B. Any gain or loss to B?
For what? Land?
Do you have any gain or loss on the distribution?
Yes, he has a gain.
Why?
Well, he gets the 10,000, so
What's
that
his outside
reduces
basis?
10, so that brings it down to 0.
Right. Thank you. And what's his basis in the land?
Carryover, so 5.
No, but he has no more outside basis. It's 0. The
Oh, that's
cash
right,
reduced
that's
his
right.
outside basis is 0.
Okay.
What's our authority?
732.
732. I didn't write it this time. We're on a roll. Any gain or loss to C, David? Yes, and how much? 5. Did he get cash in excess of his basis? Did he get $10,000 of cash? What's his outside basis?
5.
5. So gain of 5. Okay? Now, what's his outside basis, guys? Under 733, I should say. His outside basis after the distribution, David? 0, right? Everybody agree? 0. Simone, what's his basis in the property? Say again, Simone? Can't possibly hear you. You saying anything? I can't hear you.
She's saying 5.
Is it? Does our partner C have any outside basis left? No. It's 0. Everyone here has to get that. All the effects to A, B, and C, because again, if you can't see this, tonight it's late, you had a long day at work, I get it, but you gotta review this and make sure everyone can understand this. If you don't, you gotta raise questions with me. First, you gotta work it out yourself, of course, but if you're really stuck, you gotta get in touch with me. Question B? Anyone have a question? Everyone good? What result if C receives the land first and the cash in a subsequent distribution on October 1st? So he receives the land first, right? Normally, what would happen if he received the land first? Receive the land first, there's no gain or loss. Everyone agree? 731, when he receives the land, no gain or loss, right? And then 732, what's his basis in the land? 5. And what's his outside basis? 0, right? And then when he receives the $10,000, what happens? Cash. He's going to have a 741 gain of 10,000, right? He's getting 10,000 in cash. His outside basis is 0. 731 says he has a $10,000 741 gain. Agreed? Question 1C, what results is C and B above? So that was not a good outcome. If the cash distribution was October 1st, it's a draw against his share of partnership income, meaning it's like a loan. He's getting $10,000 today, but it's not really his until the end of the year when they figure out all the partnership income. What would happen?
Would not have gain.
You wouldn't have gain. Why? Let me give you a regulation site. Under 731-1A1, two little i's, I'll repeat, 731-1A1, two little i's, the draw is treated as happening at the end of the year. What's my authority? The regulation and the revenue ruling I drew your attention to, the authors did. Revenue ruling 94-4. And then where the partnership earns income, what happens to his outside basis? Goes up, right? Code section 705. His outside basis goes to 20, right? So if his outside basis goes to 20 and then he gets a cash distribution of 10, any gain or loss?
20.
No, he has no gain or loss because the cash distribution doesn't exceed his outside basis now. He's getting 10, his outside basis is 20, no gain or loss. What happens to his outside basis? It goes from 20 down to 10, right? Because 20 minus the $10,000 distribution reduces his outside basis to 10.
But he's still taxed on the 20, which is his share of the
No,
partnership
why would he
income.
be? Oh, well, yes,
Yeah,
he is
okay.
taxed on this. Absolutely, he's
Okay.
taxed on his distributive share, for
Okay.
sure. But the distribution itself doesn't give rise to a second gain, right? Now, let's explore, guys, for 2 minutes. The second problem, what you're going to see in the second problem, and I implore you, guys, this is the only way to do this, again, is to be proactive. So in the margins, I wrote down the partner's outside basis, a problem 2. I'm not going to go through it tonight, but you have to, right? The partner's outside basis is 40, and then I wrote a little chart. The adjusted basis in property 1 is 40, and the adjusted basis in property 2 is property 1, property 2. It's 40, 20, 10, 10. Now, notice what the authors are going to do. We're not going to do it tonight, but I challenge you to take 20 minutes at home, okay? Double espresso to your right, textbook to your left. Look at what it says, 2A. Asset 1 is inventory, asset 2 is a capital asset. What does 732 instruct you to do? Where do you allocate basis first? To which asset? The inventory or the capital?
Inventory.
Inventory. Okay? That's interesting, okay. What about in question B? Asset 2 is inventory and asset 1 is capital. So now they're switching because they have different gains and losses built in. What happens in question C? Both are inventory. Or in question D, both are capital. All right? And then I have another chart in question E, okay, with different adjusted basis and fair market value, right? So that's going to make your life interesting. You'll see what I mean. Now, page 752 deals with consequences of subsequent sales of distributed property. This is code section 735. Then, beginning on page 355, you look at page 355, we just looked at the consequences to the partner individually. What are the consequences to the partnership? Let me give you a hint, guys. It's easy. There are no consequences to the partnership. But, damn it, if there's a 754 election, all bets are off. Life gets complicated. All right? After we finish that section, we deal with so-called mixing bowl transactions when taxpayers seek to play games. And what are the tax consequences? And we should be able to finish this chapter up to page 382. All right? So, guys, you'll notice we didn't cover, we covered a lot, but just notice the numerical pages I'm holding you accountable for are a lot fewer. So, message, please read for next week all the material. Have a great night. Maybe I'll see some of you on Saturday night, okay?